Hi, Winter. Welcome to Winter with Grace.
Hi, how are you? Hello,
I'm good. Wait, what?
hello everyone.
Hello, everyone. By the way, you don't look like Walter White today, so I'm glad that, uh, yeah, you feel better, assuming.
Thank you. Yeah.
Okay, so instead of like the reading the super giant introduction of Winter, I'm just gonna give like my perspective. So Winter wrote this like super helpful book about like how to raise a venture capital fund, and I feel like it's a such a great read. It covers like literally everything you need from how do you get like in initial meeting, and then to what tools or like how basically it covers the entire process of like raising funding. I think it's such a great general overview for both like emerging managers as well as founders, because I feel like from a founder's perspective, I feel like it really gives you a really good perspective on how the venture capital ecosystem works. So I feel like it's a must read for everybody. And so Winter, like I will give you the mic to like introduce yourself to the audience.
Thanks. Hi everyone. Not sure how many people are listening. Can't see a number, so hopefully it's in the thousands or tens of thousands.
It
Wonder.
eventually will be, but yeah. It's night. Well, it's 8 a.m. in PT, so like I feel like most
Wake
people are
up.
still in bed. But yeah, wake up, people.
Wake
Okay.
up everyone. Wake up people. So, yep, thanks. Thanks, Grace. Great to be here. I'm Winter Mead from Coolwater Capital. It's great to be on the show. Yeah, quick background. Approaching, I guess, writing the book, How to Raise a Venture Capital Fund from the limited partner allocator perspective. So if you are an emerging manager, an emerging VC, and you're looking to raise a fund and you're always wondering or have wondered in the past, what LPs are thinking and how you should run that process, that book is a helpful guide to understand the different parts of raising a venture capital fund in particular. So great to be here.
Also, so Winter is basically, I feel like you're kind of like a godfather figure of the LP community now, because you kind of like you were the initial part of the open LP movement, and like you were very openly talk about from LP's perspective how like emerging manager raise funding. And so today I want to kind of start with you have seen over like last year you've seen 500, like not last year but like when you first started like becoming an LP or like working the LP job, like you seen like over 500 pitch from emerging managers. By now I assume you've seen thousands of, you met like everybody in the emerging manager ecosystem. You have seen a lot of things that from people. I wonder like what's your overview on the fundraising landscape for fund managers?
Yeah, the 500 number, I forget where that comes from, but that was like 1 year. I think it was 2015 or 2016 when I was at Sapphire Ventures, now Sapphire Partners. Right now we see over 1,000 and probably more after the show, like teams looking to do fund formation per year, every year. So yeah, I've definitely met with thousands. I've looked at thousands of pitch decks, probably thousands of data rooms, and have heard thousands of pitches. Have I met everyone in the space? Probably not. I'm really surprised, especially when I left the institutional LP world and kind of came over to the, I guess, more entrepreneurial world. Just how many funds are trying to get started or getting started in a particular year. I think that's a testament to the last 5 or 10 years, but I think it's also a testament to just like how many people are excited to start investment firms on a yearly basis. And there is no kind of seasonal cadence to starting a firm, right? I think these are premeditated actions that take place over years, where you have operators who are angel investing, thinking about moving into VC, or you have junior VC staff that are doing deals for years, thinking about, what if I were to hang my own shingle at some point in time, or just, people from other backgrounds that are angel investors, or just thinking about, what does it mean to start my, first proof of concept fund So there's a lot of people that are kind of investing in the early stage world that institutional LPs don't even see, right? I would say in the hundreds per year. But have I met everyone? I think the answer is no, because right, like we'll do the show and there's probably a couple more people that hopefully get inspired and say, I can do that. And they start their firm and start raising their fund. So yeah, check out how to raise a venture capital fund if you're doing that. Obviously reach out to Coolwater. And we can try to support that journey.
I wonder. Yeah, sorry.
Yeah, so I just wanted to answer the actual question, which was like, what is the fundraising market? So the fundraising market in 2024, it is hard to tell in the first 2 weeks of the year. So crazily, I've already talked with probably 100 LPs and probably 150 GPs, right? But it feels like the year is still ramping. It does feel like there's more positive sentiment than 2023, especially kind of moving into Q4 2023 and Q1 2024. Like there's more positive sentiment. There usually is at the beginning of the year, right? Everyone's kind of stretching their arms and legs. There's a lot of institutions that have new budgets. There's a lot of people that kind of took the end of the year off and now have renewed interest to get back to work. But I think it's still hard to tell. Like, are folks allocating smaller checks and larger checks? Yes, but at a much slower pace, right? Like, this is a very different fundraising market environment. At least when you're talking about GPs raising funds. For companies raising, I'd say it's definitely slowed down as well. And from my perspective, there's just a lot more time to due diligence. That was not true 2 years ago. And I think a lot of investors that are long-term oriented in the asset class in venture capital are really excited for that dynamic, because they have time to read up on the market and get to know the founding team a little bit more and do the reference calls. So it feels like that process has been drawn out, and the fundraising process for raising a VC fund has been drawn out as well. So I would expect, what is the data going to show if we look back on this time in 2 to 3 years? Greater duration, elongated fundraising periods for funds, less capital going into funds, right? Smaller target sizes initially for emerging managers, and kind of smaller fund sizes overall relative to the market 2 or 3 years ago. But that's not necessarily a bad thing. I think you can still build really great companies, and if they're capital efficient in that process, that may even be a positive thing for the industry overall.
Awesome. Hi, Andy. There's audience saying hi. But anyway,
Hey.
I want to ask you a question, such as like, I feel like you gave an overview and you have seen so many pitches. And if you're like a young, like, let's say angel investor trying to break into the emerging market, like emerging major markets, or like to raise your own fund, what are 3 things that you would do after seeing so many different pitches?
What are 3 things that an emerging manager would do?
Angel investor to try to become it.
To break in. Yeah, I would think about like what you're really good at, right? So that's a self-assessment exercise. And that, I think these things are in the book as well, but yeah, that self-assessment exercise I think is really important, because in addition to like answering why now, like I think LPs are gonna want you to answer why you. So I think that's like a super important thing that emerging managers should think about. I think as well, emerging managers should think about developing a investment thesis. So that means like, look at your body of work and like, how are you thinking about the world? And let's say, for example, you have 30 or 40 angel investments. That's quite a lot. But let's say you've built that pool, right? Like synthetically, you could put a wrap around that and say like, that's your fund 1, right? Or your fund 0, as some LPs like to call it. But then what were you investing into? Like, how did you invest? How did you make decisions like into that pool of 30 or 40 angel investments? I think if you're able to articulate that, right, that's your investment thesis. It's like, why are you investing? Like, how do you make decisions? I think that's really important and should be like iterated on a lot as an emerging GP. And then I think like the other thing is, once you've kind of gotten over those two of like, hey, this is what I'm good at. This is how I think I'm an investor, right? Putting that together into a very simple 1-pager, 2-pager, short pitch deck, right? Like you don't have to kind of, build a rocket to go to the moon. Like this is basically a test exercise, right? It's like if you want to start a startup and you put up a website to see if there's like market demand, right? It's kind of the same concept. It's like, hey, I think I'm different. I have a body of work, which in this case is like my, 40 deal angel portfolio. I think this is why, I'm kind of a different thinker and why like my strategy is going to be great. Let me just test that out, right? And so I think some people seem to go overboard there. And this is a process, right? It's an iterative process. And I don't think you want to build like too much over too long a period of time without actually like getting market feedback, because ultimately, this is a sales process and like kind of doesn't matter like what you think. It kind of matters like what the market will bear if you're going to go to market with a new fund product.
Awesome.
Hey, Jim.
Hi, Jim. So I think one of the things I was thinking, like, when you answer why you, a lot of the people who are listening, maybe they're like early on in their angel journey, or like basically younger people in general, they don't have like thousands of years of experience, or like they didn't have like an IPO company, or they have not worked at ACCZ. So like, how would you go about the why you part? Because most people just have a really good network, or maybe some sort of like sense on how, how AI will impact the world. Like, they have access into, I don't know, 5 AI deals or whatever. So I wonder, when you have limited amount of portfolio, like not like, you mentioned you have 30 angel investment, that's a lot. So like most people may not have that many investment. How would you kind of establish yourself, or like kind of like having build some sort of expertise in a category? I think you mentioned in another podcast, right now people are niching down after niching down. Like it's kind of like a PhD research paper you're building. Like you are kind of force yourself into some really deep niche, and then you're also wondering, are these niche actually have like a real market there, because it's so small nowadays. I wonder if you're like early on in your career, how would you pick that niche that have the ability to kind of eventually become something bigger, as well as like establish a brand for yourself in that niche?
Grace, I thought we had a deal that you're gonna ask me like the easy questions.
I'm so sorry. It's just coming out of my mind. I apologize.
So advice for folks that don't have 40 angel investments: get started investing, right? It doesn't matter what size, right? Like you can even build like a synthetic portfolio, right? Like think about, if you don't have money to invest in the public markets and you just say like, hey, let me pretend I'm going to do like some value analysis on this stock, and then I'm going to put it into my synthetic portfolio, and I'm going to do that for a bunch of stocks, and I'm going to have a portfolio, and then I'm going to watch that over time, right? And see like, am I a good stock picker? Right. I think there is the element of like, what is your investor discretion? And again, this goes back to like you developing that thesis because you've made investments. And ultimately, right, like if you're a fund manager, you're a manager, yes, but you're also an investor probably first and foremost. And so I think that's really important. Again, talking to over 1,000 teams who are thinking about or doing fund formation each year. There's a number that haven't made an investment ever, right? So maybe they're coming from an operating background. Maybe they like the allure of VC. I think that is a tough sell to someone if you're going to basically say like, hey, I'm now going to manage your money, but I haven't made any investments myself. Maybe you happen to be like a great portfolio manager, but like, do you really like this job, right? And this is kind of when you take other people's money, you're signing up for a 10-year commitment, at least in the US, right? It can be less in kind of other geos, but like, so I'd say to get started, like figure out if you even like investing. And then also figure out again, like why and how do you invest, right? Like that ultimately becomes your thesis and your strategy. In terms of like the niche of a niche, I think I do remember saying that at one point, like the emerging manager investing can sometimes be like getting a PhD in terms of like how specialized you have to be. Again, I think the institutional LP perspective is like they want you to be specialized, like they know where you fit in their portfolio, like if you plant a flag somewhere. So I think that's really important. And then, again, it's what do you like? What can you sustain? Like, what do you love? What can you do over a long period of time? But it is also like, bringing an expertise, I think, and being accretive to the ecosystem overall, right? Like the why you, like how are you differentiated? Like how are you not redundant in my portfolio? Are going to be some of the questions that LPs will ask. And I think that's a lot of like you being reflective, self-aware. I mentioned that self-assessment, like it's you really kind of diving into, what makes me so special and like what is my expertise and like how does that play into building my fund strategy. That's super, super important. So I would just know like what you're really good at, and also be self-aware enough to know like where you sit in the spectrum of, the most skilled person on earth versus like, someone that is just graduating from high school and like getting involved in VC, right? And is probably going to be good over time if they stick with it, but might be a little bit less experienced than that like top person in the world. So I think that's something to think about is, like what is your expertise? How would you define it? Right. And like, does it play into the fund strategy? Like if you have an expertise and you're not leveraging that expertise to the benefit of the fund returns, then, or building your firm, then you're probably disadvantaging yourself pretty severely. And then another thing is like, if you're early on, right? Like what is VC? What are VC firms, right? They're effectively like networks, right? Kind of like to say, good VCs make good intros, great VCs make great ones. It's the same concept here. Like if you're getting started, right? Like again, what is the job of a VC? You have to source deals, right? Like you have to figure out if like this is a good deal. You have to, win access to that deal, which may be convincing the founder that like you're going to bring some value to the table. You have to add value potentially to that founder or deal like after you invest. And so like that all comes down to like, what is your sourcing network, right? Maybe you have the expertise to diligence it, right? Like maybe that's your edge, right? And then it's, do you have the relationship with the founder, right? Like, can you tell other people to tell the founder that like, you're great. And this is what your body of work was and how you've worked with other founders. That's network driven, right? You making intros, like maybe it's intros to follow-on capital or something along those lines. So you made a seed investment and a bunch of Series A investors. That's network, right? So I think like if you're early, maybe the advice is kind of make sure you're building network, and the tactical piece there is making sure it's like network that has some focus, right? Because you can know 10,000 people, but if the super majority of those folks are kind of irrelevant to your investment strategy or your firm strategy, then again, like you have a big network, but it's not a relevant network. So some things to think about tactically.
Okay, so speaking of fund strategy, you also talk about like the fund construction. So basically, you have to, after picking, maybe putting 100K into certain like a few companies, and then later on, you should double down on a certain like good performed companies. Oh, by the way, Andy, will address your question later. So basically, I wonder, when you are thinking about portfolio construction and then fund strategy, how would you go about it? And then, what is some best like pitch you have heard over the years? What do they share in common?
Couple of questions there. So portfolio construction, again, like what are you good at, right? And kind of what's your personality and what do you think is going to ultimately return value to your LPs, your investors. So I think portfolio construction can change. Like I don't have a one size fits all approach. I know funds that have been very successful with 10 deals and funds that have been very successful with 150 deals. So I think it kind of depends on what you ultimately decide is doable. One way to think about that is like how many quality deals. Again, this requires like a huge amount of self-awareness and discretion, but like how many good deals are you getting, right, over the course of your fund that you can put into the fund, right? That probably determines like the number of companies you can do, right? And then there's the amount of like how much do you raise and how much capital can you actually put into those deals, right? Because if you can only put 10K in, that's very different than if you raise a bunch of money and you have to put 750K in. And so I think like thinking about those things, like where are you in the journey, can be helpful in thinking through portfolio construction. Fund strategy, I had it beaten into me that it was like very different than portfolio construction, right? So thinking of fund strategy, like what is the strategy that's ultimately going to get your LP returns? LPs a return, like a fund return. So again, thinking about that from a first principles level, like what are you good at? What can you do, right? Like maybe you're trying to build something different in the ecosystem. Hopefully you're trying to build something that's accretive to the ecosystem. That's ultimately, I think, how you get to kind of determining fund strategy. And then, yeah, the best pitch. Yeah, this is a good one. I've thought about this a lot. It's like I had a coach who turned in I want to say a graduate school thesis dissertation on philosophy that was like very, very short. I want to say like 1 or 2 pages. And so on one hand, maybe that was just like a lazy move. On the other hand, maybe it was like very different than turning in like 120 page kind of dissertation, right? So it's kind of another way to think about it is, the slogan from a prior VC of different is better than better, right? So if you're thinking about, what is
better than better.
If you're thinking about like what is the best pitch, then I think something that's clear. I definitely do not do this all the time. Like I'll just lose the audience, right? Because like you have this, especially if you're an expert in something and you're very excited about something, like if you go deep, you may go off the rails and like you'll totally lose the audience. So I think really good pitches slow it down and they recognize the audience and kind of where the audience is. And they give enough time for pauses and understanding and questions, right? It's like sometimes the best conversations for people are not the conversations where they're speaking the whole time, right? But it's the conversations where like, they're learning. And so I would go into pitches not as like, I need to ace this. I practice my 10-minute pitch and I just got to execute it flawlessly and speak the whole time when I'm on this call. I think those maybe are actually some of the worst pitches if you kind of lose the audience and you're talking for 10 to 15 minutes straight before even knowing like what someone even wants or what the alignment is up front.
How do you get to know the LP more? Because I know obviously Coolwater is a YC for emerging managers. People could talk in the program, but and like I guess like number one is like when you're pitching to LPs, like how do you even do the research? Some LPs are very out there. They have like been on a couple of podcasts. Recently, I see this podcast movement of like podcasters interview LPs. But before that, like I guess like how do people even understand what each LP's strategy and then what do they like or not? And
Yeah.
is there a kind of like a directory for LPs, so founders or like not founder of emerging manager funds could kind of like get access to it?
Yeah. Maybe there's a directory of LPs. There's definitely a lot of lists circulating of LPs. Again, I think the lists or the directories obviously are less relevant unless you have context. I think that's the truth. So even if like you come across like, I have lists of thousands and thousands of LPs, but it's like, are you just going to cold outreach them, right? Like maybe that'll work in like a vast minority of the time. But right? Like LPs are relationship driven, ventures relationship driven. So I think like the directory is less meaningful. Yeah. How do you build the understanding of like what the LP is doing?
Mm-hmm.
Some are more public, right? Like you want to pitch a VC as a founder and you go to look at their website and you kind of like see the other deals that they've done. Like in some, at least most of their deals make it onto the website, sometimes not all, but it gives you a sense of like what they're investing into.
Mm-hmm.
Some are pretty public about it, right? Because there's so much inbound, right? If you're kind of more well known and you have a pool of capital, there's a lot of inbound. And so, telling people like, I only do, series A and B, 1 to 5 million in ARR, this less than this valuation in this category type companies, right? Like you put that on your website and people are like, oh yeah, I'm smaller than that, or I'm bigger than that. And it's probably not a fit. Like you can still maybe reach out and say, hey, like I hit 3 out of the 4 of your categories or 7 out of the 10. Like, are you potentially interested in making these types of exceptions? And maybe they'll say yeah or no. But if it's like, I hit 0 out of the 10 criteria and like you're reaching out and pinging. So I think some LPs are more public about that and you can do a little research publicly. I think most LPs though are not public about it. And this is where maybe you should think about what is the skill set of like a good co-host or journalist, right? Someone that can ask questions in real time and kind of navigate in the course of the meeting, right? You could also just ask the LP beforehand, like if they want to share anything in advance. Most of them will probably say no in my experience, or they just like, will kind of say like, yeah, we'll catch up. We've got the 30 minutes or the 45 minutes for this intro call. Right. And so you'll have to be like a quick study on kind of asking the right questions and qualifying to see if there's alignment and that, this makes sense for a second conversation. But yeah, I think you're right. Like there's definitely not a huge trend to be super public about what you're investing into or not investing into. And then if you think about it for emerging managers, if there's emerging managers on the call, they're talking to high net worths and family offices, which sometimes can be more opportunistic. And so it's not like they have like this very strict mandate and this very focused strategy and everything needs to fit into that box neatly, but they kind of think about the world of investing more opportunistically. And so it's like, what I call the Hegel's aesthetics version of VC investing, right? It's like good art when you see it, right? Type of thing, where I think there might be some of that going on as well. Like when you're an emerging manager, where I talk to a lot of LPs, and sometimes I'll ask them like, yeah, what are you interested in like this year or this month or this quarter or like in the near term, medium term, and sometimes just looking for the best idea or just looking for like the best like investment opportunity. So it can be kind of general. And that's why I kind of say like, start at the first principles, like what makes you different? Like, are you creating something that is different? And if you are, then, maybe that's interesting for folks that are kind of just out there looking for something that's really interesting versus saying like, I need this exact investment criteria to kind of match up before I write a check.
I wonder, how do you kind of know yourself? Because you obviously have chat with every, I don't know, emerging manager on earth right now. And like, you have a good understanding of like, okay, here are like 5 category of people, the operator, and then the angel turns emerging manager, the, big fund, like spin-off. And then, so basically you have seen these patterns and then people will probably fall into a certain pattern. And like, but, as people who are emerging managers, they probably seen, I don't know, top like 100 different other managers top, but like they may never really hear their pitch. So they never really know if they're kind of saying the same thing with everybody, right? Everybody have a great network. Everybody is, maybe just great at deal sourcing, compared to maybe a regular person who work at another fund or another company. So I wonder, how do you kind of quickly realize where you are in the spectrum, like what category you fall into, and how do you connect with the LP that's kind of gonna bite for that particular thing?
Yeah, I think that's a hard question to answer. I think this is what Coolwater is for, right? Like I had 17 straight hours of calls, like not work, but calls yesterday, right? So it's like you kind of need to know like what the market is, right? In order to kind of know where your position is in it. You can do some research, but yeah, it's really hard. And I'd say the fundraising market changes easily on a cadence of every 6 months, right? I think, plus or minus a little bit, but it feels like there's always like these shifts happening. So you have to stay up to date on like a lot of stuff. And again, I think Coolwater, given the fact we, get pitched and talked to, over 1,000 teams a year, right? Like kind of understand kind of what sounds more of the same and what sounds kind of unique. And yeah, again, I think it is a exercise in like thorough self-assessment and self-awareness. And I think a lot of emerging managers, you can be really skilled at something. If you're really skilled at something, that probably also means like you have more tunnel vision, right? Because you've been so focused on building this expertise and so focused on like executing and becoming good in something and successful in something that you might not have the broader perspective. So yeah, it's probably less of like an internal thing and more of like, are you building the right network around you, the right set of advisors around you to maybe give you some of that feedback and help you really understand, who you are and where you sit.
I wonder, like, break down to the emerging fund manager's job. There's a couple of things, right? Number one is you have to be good at like investing. You have to select the best investment deal source and, making sure your deal get into good hands for the second round or whatever. And then in the middle, we have, the operational side. I've spoke with some amazing investors and they spend, maybe 60% on investing or 50% on investing. And then the other 40 to 50% on managing the office, like especially the solo GPs, like everybody spend a huge chunk of time to essentially managing like a LLC or startup in the fund administrative stuff. And then there's like the third part right now because is probably marketing yourself to the internet, right? Like there's a lot of, I call it like Twitter capital people, like, people who are super publicly speaking about their investment on Twitter and, building up a following to kind of like, getting to attract the best inbound leads for themselves. So I guess like the brand building / marketing is another piece. So if you're a fund manager, how would you invest your time and like how would you go about outsourcing things that you're not good at?
Yeah, it kind of depends. Again, like what's the strategy you're trying to execute on? So yeah, it's very different than a startup. Startup, if you're successful and you raise money, you kind of have that, like all of that money to use as the budget. It's very different. Like if you raise a bunch of money as a emerging manager, like it's not your money, that's your LP's money, and you're the investor manager. 50% spent on investing. I want to talk to those VCs. That sounds like a lot. I would say it's much less than 50% spent on investing if you're trying to launch a fund 1 or fund 2. Again, like what is Coolwater trying to do? It's trying to help you understand the comprehensive playbook very quickly so you can go to market and really understand, okay, what do I need to manage now? What do I not need to manage? What's a priority? What's not a priority? Yeah, how do I spend time across different functions? What's a function I absolutely need to set up, right? Or LPs aren't going to find me attractive. What's a function that I don't need to set up right now and I can kind of like delay? So really understanding like the journey of emerging manager, like how you need to set up your firm over time, I think is pretty important. Another thing to say is just like, if you're not making good investments, that's kind of the heart of it all, right? Like where is the alpha generation? It probably comes down into like the picking and the access you're getting into the best teams, right? And nothing else kind of matters outside of that until it does, right? So like there's this balance you have to strike, but knowing like the fundamentals, like what is absolutely important versus like, what can I be forgiven on like in the near term, I think is important. So that's a lot of like how I think about the cohort program and kind of giving VC's perspective on this question of like, how do I spend my time now when I'm launching the fund, now that the fund's launched, as I'm thinking about scaling the fund, like that's really important to kind of nail down. But it is different, depending on, again, like what your strategy is and kind of what you think your advantage can be as an emerging manager.
I know, like, by the way, I want to apply for the Coolwater program, of course, but like, I know you guys only take selective amount of people. For the people who are more earlier stage in their journey, how should they create a program for themselves to educate themselves before getting into Coolwater or like getting help in somewhere? And how would you kind of like educate yourself in the space, basically?
Yeah, I mean, Coolwater has a program, right? It's effectively, like you said, if you don't have 40 angel investments, like how do you get 40 angel investments? So given that our community has grown to be over 200 managers, they've invested into over 5,000 companies, actually over 7,000 companies. And they're, actively investing, right? Like we've kind of built this. If you're a accredited investor and looking to be an angel investor and looking to build out your track record and hone your thesis, like there's a place to come and, plug in. We're looking for folks that, again, can be accretive to the venture ecosystem, right? Are going to be not only just a check, but helpful to the founders and helpful to the companies in which they're investing into. That's a good way to get deals done, to build relationships with other managers, to get perspective on what does it mean to invest and kind of build a firm early and really, determine if the fund manager path is the way you actually want to move forward. I think there's other programs out there as well that are a mix of like educationally focused and maybe practitioner focused. But I think for our program, like I know we have a reputation of being like the training program and like very heavy on education, which we are. But for this earlier program, again, I think, you can't be without doing. And so the idea of like doing investments is helpful in the early days. So that's how we've structured that kind of pre-program program.
Is there like, by the way, we should totally give a plug of your new book, by the way. Do you want to talk about your new book?
Yeah. So it seems like it's written out of order, how to set up a venture capital fund. The first one, as you recall, is how to raise a venture capital fund. I think if I wrote this book 5 years ago, I probably would have written the second one first, right? But now that I've helped, over 200 funds kind of, get into business, I think it is in the right order. Like you need to kind of raise the fund first, and then you kind of need to spend cycles setting it up. Obviously, we could debate for hours on like when is the right timing and what's the right order of operations here. But I think fundamentally, like that's true, right? So what's really existential in the beginning is like fundraising, getting your fund off the ground, right? Like the basics of kind of, fund management, and like the preliminary steps of like setting up the things and getting things ready to actually like, run your firm. And then, so this book, How to Set Up a Venture Capital Fund, is really focused on like those pieces of, right? Like what is the business of running a venture fund? What are the things you need to set up now and in the future? And we have a program. We're not just one program, which I think is kind of a lot of the market just thinks of us as one program. But like I said, like we have this pre-program program. We even have a post-program program, which is more on like building the back office, which was built with one of my business partners. And it's really focused on like, great, now that you have your fund off the ground, right? You're going to be judged more acutely by your investors and your future investors. So do you have the perspective to actually build an institutional firm back office? And so again, like the book is written to kind of help you think through setting up the fund. And then this program that Coolwater runs is very focused on like building out your back office, right? Teaching the person how to fish versus like giving them the fishing pole.
When you're thinking about the fund return perspective, as LPs, I feel like LPs have really long, not LP, but like GPs have really long feedback loop. And also like, an LP may invest in like a lot of GPs. And then how do LPs keep on track of that?
Of the fund returns?
Yeah.
I mean, they have big databases, right? They'll ask for your pitch deck, your data room. They track that. A lot of them that you're pitching, right, have seen a lot of emerging managers, and they kind of run their own kind of internal benchmarking.
Mm-hmm.
Does that answer the question? Or
I guess like I know that, one of the audience, Andy, was asking, what do you want to see from GPs when it comes to MOIC
oh,
and markdowns?
the
And that's
highest possible marks, Andy. I want to see very, very high MOIC and very few markdowns. I want to see a 0% loss ratio. But
oh
this
my
is
God.
venture, so it's like, what do I want to see, and what is actually the reality? I think MOIC, right? Like, you're investing, you're probably calling management fees, you're probably calling other fees. So you're going to have kind of like, a J curve, meaning you're under the 1x of the fund return multiple, like in the beginning. And then you kind of want to try to get out of that probably in the first 2 to 3 years. In this market, and this is credit to a conversation I had with Frank Rimmerman, if you know them, the tax and audit firm in the Bay Area. I was having actually in the last week. But for markdowns, like thinking about, like we're 2 years in, right, to kind of the shift, maybe a little less than 2 years into the shift in kind of the market, right? Like I started to feel it kind of May 2022. But, the conversation with Frank Rimmerman was about like, I want to give them credit because I like giving credit to people where it's due, like where it's their idea. But the idea of like connecting kind of like the price you paid for something and the price it's valued at. Right. And those are two different things. Those are two different concepts. And fundamentally, like being able to kind of connect those two is important even before you make the investment. So stuff to start thinking about, right? Like as you're thinking about kind of markdowns, like why are they happening, right? And ultimately they happen because, people didn't predict the future in the right way, or they, reacted to a market environment where pricing was like very high, right? Like almost too high relative to, anything that the companies could reasonably grow into, and kind of like, actually meet kind of the arm's length third party market price. So I think, what do I want to see with GPs when it comes to MOIC? Like, obviously, strong numbers. I want to see fair numbers, right? And when it comes to markdowns, like, I think you're going to see more markdowns in this audit season. There's going to be additional haircuts on portfolios. I think a lot of LPs are kind of waiting to see those markdowns. But I think you're not trying to like, this is serious stuff. So like when it comes to MOIC and markdowns, like those are the numbers that define your performance, and they kind of are what they are. And I think you need to do as strong a job as possible as the fund manager to make sure like they're as accurate as possible. And again, building support around kind of each company is very important. So tracking all the information around those companies is super, super important. Does this change by portfolio stage? I don't really understand that part of the question. I think generally, like how I talked about it, I think refers to both kind of early and late, probably more late in terms of like how do you actually value these companies now. I think with early, it's a little bit more subjective, right? And it's more mark to market. But again, like I think, you can have the mark to market, but do you really know how this company's doing? How much cash does it have on hand, and like what are its prospects of like getting to the next round? Like that's pretty important fundamental stuff to know as a fund manager. So maybe it changes a little bit by a portfolio stage. It's harder to kind of adjust up or down if it's really early. But things to think about. Does that answer your question, Andy?
I think so. Thanks for the great questions. But anyway, so I wonder, how do LPs do fund construction in terms of the venture space? I know that they invest in like venture is just one part of their portfolio for most like institutional LPs. But like when they are looking at different like, emerging GPs, I wonder, how do they pick a sector and then invest in every sector of the fund manager, or do they pick like, just a couple fund manager that they like? What's their thinking framework in terms of picking who to invest in?
what is it? Is it Reese's? Like, how do you eat a Reese's? Is that the slogan? Like where it's like everyone eats the Reese's like in a different way. I think that might be it, right? Or maybe it's something else. Maybe it's Kit Kat bar. Anyway, so I think thinking of LPs like kids that are eating Reese's or Kit Kat bars is probably like the right way to think about it. I think it's going to be different. Like if the question is like, how do LPs pick GPs and how do they do kind of general portfolio construction on their end? Like I said, some people take the aesthetics version of it where it's like, I know it when I see it, right? And so like, are you the it that they're going to see and like and do opportunistically? Maybe, right? And so I feel like there can always be those exceptions in the LP world, but I think I think a lot of them, it's like they kind of define a different strategy, right? Maybe they're like, hey, I'm 80% real estate, right? And so again, this is where like to my comment on like, are you a good, investigative journalist, like in real time over the course of, 15 to 30 minutes. Because you kind of need to understand like who you're talking to, who's sitting across the table from you, what they actually like, and what their strategy is, and make your life easier, right? Don't talk too much. Don't do what I have as a problem and talk too much. It's like, figure out if they actually like VC, and they may put kind of VC, or maybe you're a search fund, or maybe you're growth or private equity or some other strategy. Just like figuring that out, I think, right, is kind of how you qualify LPs. And LPs on the other end kind of are, thinking through their cash flow. They're thinking through where they think, there's opportunity across the market. Yes, they can be multi-market, multi-asset class. So are you kind of fitting into something they find attractive? Maybe yes, maybe no. If maybe yes, like great, that'll probably be a better answer or a better conversation. If maybe no, then that might be a tougher sell, right? But maybe you're the one to convince them, right? But sometimes it's hard to teach an old dog new tricks. So if they've already kind of set their mind on a certain strategy, it might actually be hard to kind of change that strategy or that mandate. So just figuring that out, like, what's their mandate? What's their strategy? What are they interested in? Are you something that they're interested in? Being kind of frank and candid and direct about that is helpful. And then just knowing that, there's a lot of different permutations on the back end, right? I think for the most part, it probably looks like it all looks like, an LP check and an emerging manager fund, but the decisioning processes and a lot of the stuff on the back end may be different, and how people think about, making returns and creating returns is going to be different. LPs will think differently there.
I wonder, like, so what if, like, we're talking about, like, right now we're in not the best market right now in terms of like fundraising environment. I think like maybe to lean into that like not so positive sentiment, like what if things goes wrong in your first 3 funds? Let's say you were successfully raised the first fund and the second fund by just straight up hustling, and then by the third fund you're supposed to have some sort of like super amazing track record, and then what if you just don't have that in your portfolio? Should you just quit, or like maybe you were just investing you have like a wrong investing approach, or like what if like after let's not talk about 3 funds, but let's say in your first fund you don't really see any super amazing markups, like how would you go about raising funds later?
Yeah, so there's probably only so many Mai Tais you can drink on like the shores of Bermuda before like you actually have to like pay attention and manage the fund after you raise it. But in between like closing the fund and spending 5 years in the beaches of Bermuda, and then like flying back to San Francisco to like, realize like, how did my portfolio do? You probably want to be like actively managing. Like this is why the management fee exists for you to like actively manage the portfolio. Maybe it's like a fool me once, fool me twice situation, where you just realize like, it's kind of your fault. Like maybe you're not, like your strategy that didn't work out Doesn't necessarily mean you're a bad person or you don't have the skill, right? Venture is kind of a funny game. Like if we're talking about venture specifically, if we're talking about other asset classes, it's kind of a different analysis. It might actually mean you're unskilled, right? Or you need to like really change strategy. But for venture, like you might have the right, everything's right, the right decision-making process, the right frameworks, and you just kind of get unlucky, right? And so your performance isn't due to the fact that, you're bad at your craft. It has more to do with like the fact that you just got unlucky. So this is like the ongoing debate. It'll never end, but this difference, we'll never say never, but it's the difference between like skill and luck, right? And are you self-assessing and knowing like ultimately, what's luck? Like, did I get lucky? Right time, right place, or something else? Or, skill, like, yeah, I built the strategy and therefore like it was right time and right place because like I manufactured that right time, right place. And so I think being able to like think through that is an important exercise. Then there's just the reality of like, if you haven't performed for 3 funds, right? Like, again, like what were you doing on the beaches of Bermuda drinking Mai Tais? Like you should have been actively managing the portfolio, iterating, talking with your LPs, talking with your founders, like trying to understand like what's going wrong. Like, why aren't my first few investments working? Why is everything going sideways continuously for 3 funds for 5-7 years? Like, so that's, I think, a more pressing question where, yeah, like you should spend time doing that, right? Like maybe you didn't build the right back office. Maybe you didn't come through the Coolwater strategic CFO program and really understand like what the expectation was for portfolio management from institutional LPs at Fund 2 and Fund 3, right? So there's some of this stuff where if you, right, like you can be great at one thing and sometimes like you just extrapolate that and think like you're great at everything. But the reality is like, what are you really good at? I think, again, like it comes down to that self-assessment, that self-awareness. And then it's that, it's the ship is leaking. I think I'm going to sit here. We're going to have dinner, on board. Like the crew is just going to wait. The ship continues to leak. The water keeps piling. It's like, if it starts leaking and it's just a small leak, like, plug the leak and you're done with it, right? And then go have dinner. So I think there's some of that thinking, right? That mentality, that personality of you're kind of managing in real time. So hopefully, yeah, you still might get unlucky. But if like you're doing the fund manager job, which is active management of these assets in this portfolio, hopefully you can curb stuff a little bit earlier than, Fund 3. But yeah, the reality is, right, like, well, the reality might be everyone is actually top quartile. This might be Lake Woebegone, but everyone is better than average, right? But I think if you're looking at pitch decks, that's definitely true. But I think the reality is like there's only one top quartile, right, per vintage, and it's like that's the game, right? Like that's the race. You're trying to be in that, and like you're doing that in real time. And if you're not, and you're waiting kind of 3 funds to kind of like measure your performance, like it's too late.
I really like that, you can always adjust and adapt. And then also I feel like one of the advice you gave on another podcast was to just talk to your LPs and then like ask their feedback to keep them kind of like keeping in touch with them and then like leveraging them as a resources to get feedback early on than just in the end have like a really big surprise. So I have like 2 real question and like we have only 5 minutes left. I want to
I gotta jump in the
okay.
hour.
Yeah, so we have another live coming in. So if anyone who's staying for the second one at 9 o'clock, we're here. Okay, so when you're building relationship with LPs long term, I heard so many fund managers say, "Hey, like I built a relationship with XYZ LP, and when I was raising Fund 1, but they never invest in Fund 1. They come in like Fund 2 or 3." I also heard some people raise Fund 1 with a certain LP, and then the LP left after Fund 2 or whatever. So I wonder, what is a fund life cycle look like, and how do you kind of like start the LP relationship? And then at the beginning, you mentioned about like having maybe a 30 minutes coffee chat with the LPs. What do they need to hear to give you a second chance to have like a second meeting?
Yeah, so the fund life cycle, I guess, with respect to the LP. Yeah, good question. I mean, I think again, it's, you're creating a fund product that's different. Like, do you know it's actually different, right? That's kind of what the Coolwater build program, like the YC for funds, kind of helps you understand that strategic positioning. The LP is like, they're looking for something that's exceptional. So like, do you fit into that bucket? And then, yeah, sometimes it can be one meeting and they just kind of know it when they see it. And like, you might already have a brand or, such a good body of work previously that, they can decision quickly if they're the principal. And then, yeah, like, again, like, what do they want? Like, I think it depends. Like some LPs kind of don't even want to be bothered, right? It's more a portfolio allocation exercise, and they don't want to be like, your best friend and kind of talk on a daily basis. It's just like,
They don't.
yeah, I know, right? I do. No, please reach out. So there's kind of that LP, like on one end of the spectrum, which is more like the portfolio management allocation exercise. They're investing into you because they think like you're, a great fund product and a great manager. And, they want obviously transparent reporting. This is what our strategic CFO thing does. Like it helps you kind of build that function to like report as if you were reporting to institutional LPs. So there is that like part, and I'd say build that sooner than later, right? Because like if you're thinking about the fund life cycle, yeah, you don't want to get to, I think you mentioned fund 2 and then have an LP pass. You want to kind of have like the machine set up a little bit quicker than, fund 2, right? Like as soon as you kind of start making your first investments, you need to really start thinking about your LP reporting, right? And setting that up in the right way. And so, yeah, the fund life cycle with respect to like building the relationship with the LPs, like starts pretty early on, right? And then it comes down to like, do you actually know what you're building? Are you reporting on the right things? And then it's probably a cadence of, I think this is in the book, but checking in at least once per year, minimum, probably more than that. But like, again, in the early years, like you don't have that much to report on. You're just kind of building out the initial portfolio. I don't think the way to do it is like, wait until the next fund to kind of give them the update. But again, maybe again, like you're building out the portfolio, you're kind of sending a lot of updates. Maybe you won't have like an in-person until like, in advance of the next fund, just given like how remote some LPs can be and how hard it is to kind of like meet in person with every single person that might make it into your fund, which, if you're just taking QPs, can be up to 2,500 folks. It's a lot of folks to meet in person. How do you start the LP relationship? Like you mentioned, kind of the coffee chat. I know we've got 1 minute, but yeah, I think, right, like spend a lot of time making sure you're different and that like your strategy's dialed in, your pitch is dialed in, like, make it interesting for LPs, especially LPs that have options across asset classes, thinking through like, what's attractive now in venture, what are they going to want to buy right now? And being open to that. And yeah, getting that second meeting, different is better and better approach. Right. So, and like, I have this problem where I try to like squeeze like, 14 hours of material into like 30 minutes. Just know that like a lot of LPs don't work on that pace. They're like trying to build a relationship over a period of time. Like they want to do the lines, not dots approach. And so like, you don't have to fit everything in, but be interesting enough in that first meeting where there's the potential for a second. So I think with that, I know you got your next meeting coming in. And Andy, thanks for the questions and being the most active person in the chat.
Totally. Everybody else is lurking, but Andy is asking. So good for you. Anyway, Winter, thank you so much for coming. I want to end on the note of like Winter is gonna, change the landscape of the emerging manager industry, and then he is gonna save the humanity by investing in the right managers.
No, just small tasks.
Okay.
If anyone's into saving humanity with me, let me know.
Okay. Okay. Apply to the Coolwater program. Myself, I'm applying. Please let your assistant let me like get to the next steps or something. But anyway, thank you so much. Appreciate your time.
Amazing. Thanks, Grace.
Okay,
Thanks,
I'll
everyone.
let you go.
Okay. Do I just press leave studio?
Yeah, I'm gonna end the stream.